FRK 311 IAS 8 continued. Please note this work carries copyright. Now we're going to continue with the correction of errors. Errors made in preparation of financial statements of prior periods may be discovered in the current period. And these errors may result from the mathematical errors, from errors in the application of the accounting policy, misinterpretation of facts, fraud, or omission of information. Material errors of prior periods. Definition. An error discovered in a current period which has a material effect on the prior period financial statements and which causes those financial statements to no longer be reliable, and the error could have been corrected when the preparation of the financial statements of prior periods was done if the error was detected at that stage. Let's summarize. An error must be material. An error will relate to the prior period financial statements, and those financial statements are consequently unreliable. Accounting treatment. An error in the current year. When we discover an error in the current year, all we have to do is correct those financial statements and nothing further. But if we discover an error was made in the previous years, that means our comparatives are incorrect. So we have to then correct those comparatives and restate them. Now, if an error was discovered in the year not presented, in other words, the year before the previous year, then we have to adjust all the opening balances of the comparative figures relating to that error. Therefore, current financial statements are presented as if the error was corrected in the period in which the error was made. Therefore, retrospective adjustment. Now, if it is unpracticable to make these changes, then we can partly retrospectively do the adjustment or do the adjustment prospectively. Errors versus a change in accounting estimate. A change in accounting estimate changed because additional information became available. In other words, it could not have been avoided, whereas an error could have been avoided had we picked it up. The tax implications. We can have a current and or deferred tax implication depending on the situation. Current tax is only affected if SARS reopens previous assessments. But we do find that SARS will not automatically reopen those previous assessments. So a question must specify whether SARS will reopen those previous assessments or not. Now, if they do not reopen those previous assessments, then we will have deferred tax implications on these adjustment of the errors. This we will explain to you by way of class example. Disclosure of prior period error, note. Now in this note we will say the nature of the prior period error. For each period presented, we will then have to give the amount of the correction for each line item in the financial statements affected, as well as the effect on the basic and diluted earnings per share. Now for periods that are not presented, in other words before prior years, those amount of corrections against the opening balance of the comparatives must be adjusted. Where your retrospective restatement is impractical, we must disclose the circumstances that led to this condition, as well as how and from when the error has been corrected. Now we will only disclose this in the year that the error was discovered. We will make this correction, and not again in subsequent periods. That's the end.